So we do have to have, unfortunately, still some charts on COVID, and I've just got two in here, and it's really important, in my mind, to be watching how the pandemic is developing, because it really factors back into the economy, inflation, and how we want to, be making asset allocation decisions. And the thing I'm watching every morning, and when we wake up, sort of watching what's going on in the new data, is looking at the UK, and there's a lot going on here, but this is the black line here is the case count for basically now. This is the summer 2021 wave, we're calling it. And the solid red line are cases from the fall 2020 wave. And then the dotted black lines are, it's a grim statistic, but it's fatalities for this summer due to COVID. And then the dotted red line is the fatalities from the fall 2020 wave. And I just want to sort of point out here, that there's been a really strong increase in cases in the UK over the past couple months, and we're not seeing the same relationship with fatalities. And the UK just had Freedom Day, I think, a couple days ago. They had a full reopening, and there's a lot of mixed opinion on that. But there's sort of, in the way I think about it, there's sort of two places we're moving into, and I think this feeds into how the market will start pricing interest rates and everything else as we sort of move forward. If there remains a lot of cases, but fatalities and hospitalizations stay low, the UK is a pretty well vaccinated country. I think that will serve as a model, and now we're moving into a different state of the pandemic where perhaps, and I'm just trying to make a leap here, COVID is truly moving more into being sort of a less sort of disruptible virus. The pandemic starts, people look at it differently. If ultimately hospitalizations and fatalities start rising, even though the UK is pretty highly vaccinated, then that's an area of concern. And I think the growth scare element starts sort of feeding back in. As of now, and we're pretty well into it, it certainly looks like COVID, at least in the UK, is becoming less deadly, even though cases are rising. Without drilling too much into it, there's a lot we don't know about the vaccines right now. The real test to approve the vaccines was if these 1,000 people had vaccine and these 1,000 didn't, what's the difference in hospitalization? But we didn't really we don't know, like, do the people that have vaccine, are they able to get infected but not really get sick, sort of become silent carriers, and ultimately that will make COVID look perhaps more like a cold. So I think it's really worth watching a chart like this. Again, most people are sort of producing these now, and you want to make sure that the black lines don't move together, and the dotted lines, the sort of dots, stay really low. That turned out to be the case. The UK was able to open. They had this wave came down. They didn't have to sort of do closures. Hospitalizations didn't increase. Fatalities didn't increase. I think that's a very different outcome. And as a matter of fact, I think if you poll most investors these days, there's a lot of concern about the Delta variant and the vaccine efficacy and all of that. From what I can tell, I would imagine that this sort of disconnect is going to stay in place. Things could always develop, but I think that will be possibly a lift for the market if we see cases finally ebb in the UK and not having gone through this whole wave of closures that we've been seeing, economic shutdowns over the past year and a half.
Yeah, I think, as you point out, this is one of the most important things out there, because this drives kind of the behavior of the consumer, and like if they're going to go out and spend, right? And if they're going to get out of their house. And I get it, like the fear for people that are vaccinated. There's a group that thought, oh, I'm vaccinated, well, I can't get COVID. You can, right? And I think that people are now realizing that you can still get it. And if we see that the death rates and like the severeness of the symptoms doesn't increase, then I think that's going to get people bulled up to continue that behavior of, getting out of their house and spurring the economy along, right?
Yep, absolutely. That's the way I'm thinking about it. The other just an interesting note, I think it's way too early to tell what the seasonality of COVID cases looks like, but it is interesting to note just about this time this year. Now there's a little bit of a lag here, but we're kind of in the zone of where cases in the U.S. were rising and they sort of peaked out somewhere. If we want to run a little bit of lag here, maybe over the next couple of weeks, if we follow the pattern of last year, we should see cases sort of peak out. I wouldn't put too much faith in this, as this chart is not nearly as important as the prior one, but it's certainly worth watching. So we've talked about interest rates. I think it's really sort of one of the most important topics to be thinking about now. Certainly here at DoubleLine, it's something that we think about. So what I want to go through in this section is looking at maybe some of the reasons why we've seen a big rally in interest rates, as we showed early on in the presentation, right at the end of Q1. That was the highest point of the US 10-year Treasury, and we've seen rates rally since then. And I don't think there's a really one simple, succinct answer to why we've seen rates rally. I think it's a variety of different factors that I'm going to lay out here, and we can sort of, after this, sort of talk about maybe where we're going from here. And the first one is looking at seasonality. This is the past 30 years, the seasonality of the 10-year US Treasury yield by month. And what you'll note here is that, I was going to say on average, and you can't see the black lines, there's also on median, we tend to see rates rally May, June, July, August, even September. So there's just a seasonal backdrop. And I think a lot of this goes into a lot of factors of, sell and may go away, that sort of old phrase that we've always heard. And typically August is the biggest rally. We tend to see rates rally 14, to 16 basis points, depending on whether you're looking at average or median. So keep this in the back of your mind. We tend to see rates go up in February and March. This is not foolproof. I would not invest on this, but it's something worth considering, that we do tend to see the seasonality in the way that interest rates move month by month. The other thing is we have this annotated. This is another look at a chart we've already looked at, but here we're just sort of showing what I think is another factor, and that is the Fed. And on the 16th of June, the FOMC, we've got it annotated saying the Fed appeared more hawkish than expectations. And really, since that point, you've seen rates rally about 25 basis points. So we're moving into seasonality. Fed comes out and doesn't say they're going to hike rates. They say, basically more or less that a rate hike somewhere down the road at some point is possible, and sort of shifted some of the language. But it certainly was an accelerant to seeing rates rally after that FOMC meeting. Now, they were already sort of trending a little bit lower, very gently, and that really sort of accelerated to the downside post FOMC.
They just got to move the dot plots, and it's a free option, and they can move it back down later.
That's right. It's a great, beautiful way of operating, where you talk about how you're going to move in the future without having to do anything, and that gets reflected into the market. It's really, it's as close to magic or alchemy as you could hope to expect in financial markets.
It's the wizard behind the screen, right?
Absolutely. Another more powerful chart is looking at the yield curve. This is 5/30s. That's basically the 5-year US 5-year Treasury to the 30-year Treasury. That rate, that spread, and here you can see very clearly after that FOMC meeting, the yield curve flattened really dramatically, at least looking at the 5/30s, from about 140 bips to 120. Obviously, these are not big numbers for those looking at markets, but for bond markets, you can just sort of see that's basically a stair step down in terms of expectations. And that, generally speaking, when you see the yield curve steepening, growth and inflation are moving up. When you see the yield curve flatten, all else equal, that means that somewhere down the road, the market is pricing in a slowdown of the economy. And one interpretation here is that the growth, and particularly in the later years, was sort of repriced lower, because the market now was assuming that the Fed is going to do something and is not going to stay, sort of keep their foot on the pedal, the gas pedal, for forever.
Yeah, it's interesting. Like right around that time, it seemed like up until kind of March, April, and even May, the kind of feeling of the market was that the Fed's behind the curve. Like, there's so much inflation, they're behind the curve, they're not going to raise rates soon enough. I remember Paul Tudor Jones was on CNBC saying, if they don't do something at the next meeting, which was that June meeting, then buy gold, sell the bond, sell long-term treasuries, because their inflation is going to be runaway. And then the Fed came out, did a little, slight maneuver, didn't really do anything, but just, as you say, talked about maybe they'll hike rates. at some point in time, with their dot plots. And then fast forward 30 to 60 days later, and now it seems like the conversation is the Fed's hiking too soon, right?
Yeah.
And the Fed's going to like choke off growth yet again, right? They're doing it again. They keep doing it.
Yep.
And that's that big flattening happening, right?
Yeah, that's
And
absolutely the narrative shift. Yeah. And so most people aren't looking at euro dollar futures. So euro dollar futures are basically a financial instrument where you can trade what the Fed will do in the future. I'm simplifying it there, but what I want to point out here is that the yellow line, which was basically what the market believes the Feds will end December 2023 with, that didn't shift. What you see is that the green and purple lines, now those are basically, again, we're getting real esoteric here, but the green line is December 2024, where the market expects the Fed funds rate to be, and then the purple line is December 2025. So basically, when you look at this, you can say, okay, the market's not assuming there's going to be any real shift in the near term, but the market got a message from the Fed that in the later years, the Fed is going to be more aggressive. It's kind of a funny set of logic because, again, we're talking about 3-4 years from now, but that is part of the reason why we saw on the prior slide the yield curve really flatten. It's those expectations further out that have really come back. And again, I just want to point out here, the peak was right around the end of Q1. So a lot, when you talk about the tale of 2 quarters making up the first half, it's really Q1, market pricing in inflation and growth and maybe overpricing, and then Q2 starting to sort of calibrate that downward, and then the Fed meeting in December maybe even push that more to the downside.
Yep.
Another thing that we've talked about is pension fund rebalancing. Pension funds hit close to 100% funded. And when they do that, all else equal, you would tend to see a rebalancing into bonds. In fact, Credit Suisse coming into the end of Q2 assumed that the pension funds would rebalance into fixed income. And so they'd basically be buying more fixed income and selling equities. These are not large numbers. What we're laying out in this series of charts here is some of the variety of factors that I think really sort of culminated in Q2 to lead to the rally. Another thing is, I think you spoke earlier about the effects, the sort of growth scare. And one of those things out there is to be thinking about is that workers are starting to, particularly in, I think there's 20, 25 odd states right now where the pandemic unemployment assistance is starting to roll off. I think it's rolling off nationwide in September. So you're going to have a set of stimulus sort of coming out of the market. And I think that's sort of, somewhere in the equation here is, in fact, I think this is a really interesting chart. The white line here is the New York Fed weekly economic index. So you could, if you line this up with GDP going back 10 years, it lines up quite well. And this peaked out right in the first month of Q2, right around April. And you can see the white line again, the shaded area, the green area. It's not crashing, but it peaked out and it's starting to sort of come down a little bit. This is sort of like a proxy for expectation for economic growth. We also have lined up here, the yellow line is the US 10-year Treasury. So again, they both peaked out. I'm not really looking at the magnitude of shifts. I'm looking at sort of direction shifts. They bottomed out early last year when the pandemic came on. Rates bottomed out. This number bottomed out. They peaked out right around the end of Q1, Q2. So when you sort of put all of these together, we've laid out, what I think is sort of paints the picture that a lot of things inflected in Q2 to sort of probably move rates to the downside. The real question is, are we overshooting down, and what sort of comes into play? We've talked about the COVID chart, where if it turns out the UK is able to successfully open, then that probably lays the framework for thinking about the US, and maybe concerns about COVID go down a little bit. And maybe maybe the rates start going up because expectations for growth and inflation start moving up. But I think when asking and answering the question about, why we've seen this rate rally, it's a bunch of reasons. It's a bunch of different factors that sort of lined up. And I think looking at it through this lens is really helpful.
Yeah, I joke and call it the perfect storm. It was all these, 4 or 5 different forces that came together perfectly.
Yep, exactly. Just sort of last on this topic, we have generally been looking at we like to look at a lot of baskets and equities. We might look at value versus growth or bank stocks versus the S&P, and looking at how different groups of stocks or asset classes, for that matter, how they're moving together can be really telling. And when you want to think about the so-called growth scare, one of the things that we would think about is here we're looking at the ratio of reopening stocks. So think about that as Delta Airlines and movie theaters and stay-at-home stocks. Think about those as your Kroger's, your grocery stocks. Not sure what else in the basket, but certainly if they're toilet paper manufacturers might be in there. That's the orange line. And that peaked out again early in Q2, and we have lined up with the U.S. 10-year Treasury. So one way to think about this is in early 2020, that ratio was sort of flat, and then really growth expectations started increasing early in 2021. So the reopening stocks started doing better. They outperformed the stay-at-home. Interest rates were rising. And in the middle of Q2, we started seeing the reopening, some calibration of that. And the stay-at-home started outperforming the reopening, had some, selling off of the reopening stocks, and that moves in line with U.S. 10-year Treasury. So again, we've lined up here. We've got pension funds. We've got this, some of the fiscal stimulus rolling off as is planned right now. We have maybe a growth scare and really some uncertainty about COVID. And all of these factors sort of lined up, I think, to create the perfect storm, as you call it.
Yep.
Okay, so sort of move through some asset classes. That's the economy. And I'm really starting to think about, when we think about asset classes right now, I think there's the fundamentals, which generally tend to look good. There's the momentum and the technicals, which particularly up until this week, generally we're looking pretty good. It's the valuation that really tends to be the issues. And I think going through a few charts in this really sort of spell that out. First, starting with stocks here, you can see that earnings. These are the earnings by year, going back to 2017. The red line is 2021. Earnings are really, really strong, particularly on a growth basis. Of course, we're comparing to 2020, but really high percentage increases. You can see 2022 in there. It's anticipated to be higher than 2019, 2017, not as high as 2018. But I would say the earnings outlook in stocks is good. So the fundamentals there are sort of good. We talked about the economy and inflation, which are both quite strong. When you look in credit markets, here we're looking at the high yield upgrade downgrade ratio. It's above 1. That means we're seeing more upgrades than downgrades. For most of 2020, we're seeing the reverse of that. So the sort of economic or the credit cycle is pushing up to more upgrades and downgrades. And you see the same in the high yield default rate. The high yield default rate has come down. It peaked out a little bit above about 4%. It's moving down, makes sense, particularly when you think about the prior chart. So at least for now, it looks like we've gone through this credit cycle. We didn't peak out at very high defaults, but we're moving to the down slope, we are in a low default environment, looking at the trailing 12 months. Look at the consumer, an area I know pretty focused on. The consumer really had a relative high level of bankruptcies post the financial crisis, 2008, 2009, 2010. And their balance sheets have been sort of working into positive territory, very low levels of bankruptcies. Yes, there was a lot of stimulus in 2020, a lot of weird, sort of economic programs, at least compared to what we're used to. But the fact remains that bankruptcies with the consumer are quite low. So again, fundamentals here are, I think, the consumer, at least looking at bankruptcies, and I think if you look at their balance sheet, looking pretty healthy.
Yeah, I think even going before the pandemic, they were already in a better spot. People were less levered, savings rate was already elevated, and of course, the stimulus checks didn't hurt.
Yeah, absolutely. So that's a look. I mean, that's a very quick look at fundamentals. I mean, we pretty much covered the fundamentals, talking about the economy and growth and inflation, and I think it all looks good. The question is, when might that sort of shift? And that is the right question. But what's important for risk markets is certainly thinking about the inflation cycle, the economic cycle. But the fundamentals, I think, generally look pretty good. And then when we look at just sort of the technicals, we're calling this momentum, but this is just looking at the direction that asset classes are moving. This is a chart that we looked at earlier to sort of point out we're running on high levels of return in the growth sectors. The S&P is above all of its moving averages. It did earlier this week sort of dip right below or touch its 50-day moving average, but it's above its moving averages. Wasn't sure exactly where to sort of put this, but almost from a technical standpoint, if you look at areas of structured finance, particularly the non-agency mortgage market, there's a lot less supply. Again, I know you know a lot about this. We're having a large supply of treasuries being issued, a lot of corporate debt being issued, not a lot of non-agency RMBS. So the technicals in some parts of the market are looking even stronger. I'm not showing on here, for example, all of the sectors of structured finance are continue to do well. So the fundamentals look good. There's a lot of momentum, and momentum is a really important factor to think about in risk markets. I think it's really the valuations where the question marks come into play. The first place we're going to start here is looking at the dividend yield of the S&P versus the 10-year Treasury. The dividend yield of the dividend yield of the S&P is, at least when we made this chart, is higher than the 10-year Treasury. If you look in the lower panel, going back all the way to the early 1970s, that's a pretty rare event. We've seen that through parts of 2020. I think Jeffrey's been talking about this. If you look at the valuations, particularly in the 10-year Treasury market, they're pretty yields are pretty low. So I think one could make the case that 10-year Treasury valuations are quite rich, and particularly when you compare them to the S&P 500. Obviously one of these is cheap and one of these is rich, or perhaps they're both rich, but one is just less so than the other. And when I look at this, I definitely have to take into account the fact that the 10-year Treasury is not even yielding more than the S&P, which is already a pretty meager yield at 133.
It's a big argument people make for why you should continue to own equities.
Right? Yep. And it has been for a while, and it has worked for a while. So I'll certainly point out both of those facts. Yeah. And speaking of the 10-year Treasury, we looked at it versus we've looked at this many ways today, but we looked at it in the last chart versus the S&P dividend yield. Here's looking at it versus inflation. And so what we're doing here simply is looking at the 10-year Treasury yield, and we're subtracting out CPI, and it's a negative. The number we're getting is -4%. And you really have to again go back to the early 1980s to see a time when you could earn less in quote unquote real terms. There's many ways to calculate real yields, but the way we're doing here is a really simple way. So at least looking at this way, 10-year Treasury yields versus CPI is not very attractive. We like to talk about the copper gold ratio here at DoubleLine. And we like to point out that they move in similar directions, and there's a lot to be gleaned from that. So the top panel, the gray line is the copper gold ratio, and the red line is the 10-year Treasury yield. We don't have it on the chart, but we also run a regression here. If you run a regression and you sort of take the history of how they move together and all of those mechanics, it basically tells you the 10-year Treasury yield should be about 100 basis points higher than it is right now. And you can see, just going back over the last 3-4 years, generally these move in the right direction or direction together or correlated. But there's really been a big disconnect this year. The gray line is pretty high, and we've seen this rally in 10-year Treasury yields. So, we talk about a lot of reasons. The Fed's buying a lot of treasuries. There's not a lot of sort of free float there. Could be a lot of demand for treasuries, but the fact of the matter is, at least looking at this metric, yields, 10-year Treasury yields look either that or the copper gold ratio is really mispriced. So one of these two is off, and this is a question mark, I think, for 10-year Treasury yields.
And interestingly, 100 basis points higher, 225 was probably consensus average economist expectations for where the 10-year would end at the end of 2021.
Yeah.
At the beginning of this year, right?
Yeah. One of my question marks is we went through a period in post-World War II of yield curve control. And, in that case, it was pretty explicitly announced, we are going to buy X bonds if they are above this yield, and they did that. I think the real question today, and we won't know this, maybe 10 years from now, we look back, have we entered into some sort of, implicit yield curve control by the Fed. Certainly when you look at the actions of the Fed, I mean, I think there's been quarters or months where they're buying more treasuries than have been issued. So, are you in yield curve control if it's not properly, sort of explicitly announced? I guess time will tell. One area I think that would make treasuries look attractive is, and we have to sort of take into account, is foreign buying. Looking at the orange line here, this is 10-year treasury yield hedged into yen. And the line has been coming down over the last month or two, but it's actually quite high if you look back, going back to say 2015. For Japanese or yen-based investors, they can earn 95 basis points. At times that was inverted in 2019. You actually lost money buying treasury yields. So want to sort of be fair to the treasuries, and for foreign investors, it certainly looks attractive still, even with the rally over the past couple months. Agency mortgages. So we're moving through in this section as a couple different asset classes to show that a number of asset classes are looking stretched in valuations. At least on a simple terms. Here we're looking at agency mortgage spread. One way to look at agency mortgage spread. There's many ways to do that. Here you can see going back to 2000, we're comparing the 30-year to the 5 and 10-year Treasury, and here you can see spreads aren't at their lows, but they're pretty close to it. There's many charts that look like this for different asset classes. But if you ask investors, and BAML did that, do you think mortgages agencies are overvalued? This is from May. So, I think that we might get a little softening in this. We'll have to see. But mortgage investors back in May said very, very overvalued, and they had a different opinion for high grade. Will also be interesting to look at what performance was like over the last couple months. But this theme, and here I'm just showing one example, this theme of how overvalued are things. I think you see this across a lot of asset classes. I don't have these questions across every asset class. We pulled this because we had it for mortgages and high grade, but even back in May, a lot of concern about valuations across asset classes. And looking at credit, here we're looking at spread changes since before the pandemic. We showed earlier that there's been really good returns in triple C bank loans, triple C high yield. Here you can see where spreads are. Triple C high yield is 300 basis points lower than it was pre-pandemic. Most of these are sort of in the zip code of really having gotten right back to the place of where they were pre-pandemic, but you will note almost everything is sort of lower. So we're actually trading with tighter spreads across the board versus pre-pandemic. It just so happens as well that in certain parts of the corporate market, particularly triple C loans and high yield, spreads are even much, much lower. But even if you ran an average through all this, you'll still see generally spreads are tighter than they were pre-pandemic. Barclays ran analysis looking at investment grade spreads, and I'll sort of read part of what they say. The index is also significantly longer in duration and worse in credit quality than in 2005. So adjusting for ratings, maturity, and price, spreads are nearly 13 bips through their tights. I mean, a lot of different sectors are showing this at sort of all-time tights, but it is the most acute in investment grade, where spreads are tight on a nominal basis. And then if you run this more exotic math that Barclays is running, which isn't that difficult, but they're taking into account other factors, it looks pretty rich. Looking at equity valuations. Now, when you compare the dividend yield to the 10-year Treasury, you could say equities are cheap. But when you look at the CAPE ratio, which is a good long-term way of looking at equities, you see that the U.S., particularly the U.S., the blue line, is at pretty high levels. You really have to go back to the late 1990s to see a higher CAPE ratio. Not so much in emerging markets and other developed markets, but particularly so in the U.S. So we just went through, the fundamentals, some of the momentum and the technicals, and looking at the valuations. I think when you sort of put these together, it's exactly where we started. The fundamentals look good. The economy looks good so far. Again, we always want to watch out for how things are going to be developing in the future and where the risks are. And the momentum, generally speaking, is good across risk sectors. It's just that all the valuations are so rich. And I think it takes a lot of brain power to constantly try to not only recalibrate your big picture view about when that next recession or slowdown is coming, but also trying to find value in different sectors. I'm not including it here, but for example, corners of the ABS market are still, the aircraft market still has areas that are relatively cheap and are not at their sort of 5-year, 10-year tights. There's parts of the equity markets that's the same. There's certainly many parts of different markets, and I think there was this real big, is this a stock pickers market or sort of a passive investment market? As we were talking about ETFs, I think this is really sort of like an asset allocators market, or a sort of sector selectors market. It really is a good time for active management. It's a bad time in the sense that most valuations are pretty rich, but there are corners of the market where you can sort of find value, particularly if you're able to sort of roll your sleeves up and get into it. And I think the last chart I'll end up on is a really interesting one. This is high yield and headline CPI, and you can now see that the high yield market has a lower lower yield than the last headline CPI number for the first time since we could make this graph. I don't think there's a whole lot to do with this. It just sort of speaks to some of the weirdness of the markets that we see out there today. So that is my quick, not so quick splash through the world.
I think it was a really good overview. I think you laid it out well. I mean, the growth and inflation are here. How long will they be here? That's kind of the debate. And then as we go through valuations, and I tell investors, it's a tough time to invest. Rates came down. We were kind of given a gift of slightly higher rates for a little bit, and now rates are low, spreads are tight, PE ratios for stocks are relatively high, and so what do you do? I don't know if the sell in May go away is accurate. I tell them doing nothing might be a pretty decent move right now for the next marginal dollar. Just kind of cash doesn't go down in price, and hopefully we'll see some vol. I do think we'll see some vol because there's these uncertainties that you kind of laid out. Maybe another surprise of inflation to the upside. Maybe it's geopolitics. And seasonally, the end of the third quarter, fourth quarter, usually there's a pickup in volatility. So it just seems like a good time to wait and watch and be patient. What do you think?
Yeah, I mean, there's certainly not a lot of cost in most asset classes. I mean, if you're an investment grade, looking at investment grade yields or most yields available in the market, particularly in the fixed income market, there's not a whole lot of cost. Although, looking at a chart like this, if you're a believer that inflation is going to be more sustained and you think inflation's sort of chewing away at your dollar, that's certainly something to take into account. But I don't think in general, when valuations are really high, it's not the worst time to sort of have a bit more cash than you might otherwise have. I sort of felt last week not the same, but a little bit of a deja vu to February 2020, where most asset classes were sort of priced per perfection, and we had this sort of burgeoning. We didn't know at the time pandemic. It was sort of slowly sort of start to percolate. And then it all sort of, was quickly sort of realized by the market. And we had a very turbulent March and April. I don't think we're facing anything near that same magnitude, but, over the past week, there's been a lot more concern about growth, and you've seen, stocks really have a pretty strong sell-off on Monday. I think the path forward is really watching what happens with the pandemic in the UK, inflation, and again, I'll probably take the over on inflation being transitory, if transitory is defined as the next 6 to 12 months. Beyond that, it's really hard to say, but yeah, there's a lot going on out there to sort of keep your eye on. And I think a day like sell off like Monday is probably a good day to see if you can find opportunities. The problem is I think everyone else is thinking the same thing.
Yeah, the buy the dip worked again. Yet again.
Yeah.
Well, Sam,
lesson learned over and over again.
Thanks so much for taking the time to put these slides together and joining us. We really appreciate it, and we look forward to maybe having you on at the end of the year as we look towards to see what 2022 holds for us.
Okay, sounds great. Thanks, Ken.
All right, take care, Sam.
Thanks. Bye.
Bye.